Hi guys, today we're looking at Sunoco, and this is headquarters in Dallas, Texas, and is a wholesale distributor of motor fuels, and it distributes its fuel to more than 7,300 Sunoco branded gas stations, and of course is the official fuel of NASCAR. Let's have a look at the share price since the pandemic. You can see actually pre-pandemic it was around about $31, $32 a share, hit lows of around $10 in the pandemic, so that would have been a great buying opportunity, and has rebounded very strongly and is actually past its previous pandemic prices. So let's have a look at my 7 steps. Firstly, Sunoco is in the energy sector and has a market cap of 3.5 billion. And let's have a look at step number 1. So does Sunoco have a PE ratio less than the market? It has a very low PE ratio of 7.07, so that is a pass. Is it lower than the sector? Sector is 8.02, and with a 7, again that is a pass, and it's lowest than the historical average of the S&P, so that's 3 passes off the bat with a very low PE ratio. That's very good to see. Is Sunoco's revenue increasing over the last few years? And the answer is no. It's gone from 11 billion to 10.9 billion, but this is in still the throes of a pandemic, so under a normal year I would have said this would have increased, but it failed nonetheless. Is the profit increasing? And yes, it is. It's gone from 150 million to just under 500 million, so that is a pass there. Are they buying back their shares? Yes, they are. Gone from 99 million to 83 million, so that is really good. Just want to say thank you for watching. Please leave a like on the video if you've enjoyed it, and so consider subscribing if you want reviews on more quality American stocks. Now we want to see if the current assets are greater than the current liabilities, and yes, it is. 850 million to 650 million, so that's a pass. Current assets are not greater than the total liability, so I'm not giving them an extra mark, but their current assets are greater than their current liabilities. And the final step is the free cash flow increasing. Yes, it is. 300 million to 500 million, so that is a pass. Free cash flow yield of around 14% and trading for just under 7 times free cash flow ratio, so that is really good, looking very good initially with 7 passes, 6 passes and a bonus mark, and only 1 fail, with revenue being slightly down, but with the pandemic that isn't a bad thing at all. So one of the things that I'm sure has brought you to the stock is that 9.4% dividend yield. That is an 82 cents a share dividend amount paid quarterly. The ex-dividend date was actually on May 10th, and there'll be a payment day in May 19th, so there was some sell-off after this, but make sure to buy the shares now if you want to be paid again in a few months. Is the dividend safe? Yes, it is. It has a payout ratio of around 66%, a little on the high side, but no worries there. It has 9 years of dividend growth, and currently is a moderate buy by the analysts. As you can see here, they have it on a slight upside, but I think this number is a little bit on the bearish. If we look at my discounted free cash flow model and my Buffett-Graham intrinsic value, you can see I've calculated the future free cash flows, and that has given me a calculated stock price of $51 a share, which means it's currently trading at a 46% discount. And if we look at the Buffett-Graham intrinsic value, it is giving a fair value of $46.99 and a Graham price of $35.25, which is just about where it's trading now. So the Graham price says buy it right now. Even this is with the low expected growth rate of 2.6%. Even then, it is still a buy according to the Graham price, having it a fair value at $47 and a buy price for Graham at $35. So this is a very conservative number. If you want to buy the stock and hold for 20 years, this is the price you'll be looking at, and it's an excellent opportunity to buy right now. Also, you can see that these numbers are pretty close, $51 and $47. So these models are both saying it's a buy and are pretty close in line as well, which is really good. And if we had a look at some quick technical analysis here, I have a 50-day in blue and a 200-day in gold. And if we see here, there was some bullish price movements in September where the shorter day crossed over the longer day, and then once again in November when the price broke past both averages again. So the price has been trading above the averages here. It has been acting at a little bit of support, hasn't gone below the 50-day moving average since October, so it definitely is providing some resistance here, which is really good, and the 200-day is diverging as well. If we also have a look at this parallel channel here, you can see that the stock price has not really broken above or below this since June of last year. So looking here, you can see it touched the peak at there around $37 and it's on its way back down. So if you're interested in here, you could wait till it gets to the 50-day moving average, buy again then, and maybe take some profits at around about $37, $38 a share. If the price goes to as low as 30 or even 29, which is where the 200 days, that would definitely be massive buy signals, because the price hasn't gone outside of this channel since the pandemic. Right guys, I just want to say thank you for watching. Please leave a like if you enjoyed the video, give it a comment on your thoughts on the stock, and I'll be bringing you more quality American stocks. I have done a slight rebrand on the channel. It's still the same, but I just wanted to give a name to the channel which is more representative of what the channel is providing. The majority of the people who are watching this are American, and they want to know the best quality American stocks that they can buy. So I just want to say thank you for watching, and I'll catch you guys next time.